Today is Wednesday, December 23rd, Christmas Eve's Eve. And this is a post-market analysis for the stock market activities today. We had a low volume, muted day per usual. As expected, we saw a gap higher and then trading flat throughout the day. However, during the last hour of trading, there was some funny activities and the market flushed down. Whether that is notable activities or not, we will see tomorrow. However, we will look at the charts and try to figure out what the deal was during the last hour of the day. Why were the algos triggered? We have the usual coverage for the options market, the charts analysis. However, during the conclusion of this video, I will answer some of the viewers' questions, specifically regarding the mechanics of the options market, how it works, picking dividend stocks, and Kroger stock. And with that being said, here we go. The Dow Industrial Average closing in the green by 114.32 points, or a gain of 0.38%. The Nasdaq closing in the red by 36.80 points, or a decline of 0.29%. The S&P 500 barely in the green by 2.75 points, or a gain of 0.07%. And here are the sector's performances for the day. Remember, the last 2 days we saw the US dollar rising, and therefore you saw dollar-sensitive sectors such as energy, materials, industrials closing weak. Today we saw the opposite picture. The US dollar declined for the session, and you see right away energy for number one in capturing the gold medal, financials at number two capturing the silver. Of course, along with the decline of the US dollar, we saw a rise in the 10 years treasury yields that would help the financial sector. And at number three, basic materials capturing the bronze medal. The laggards of the day: technology, real estate, and consumer cyclicals. Moving on to the futures market performance for the day, as I said, we see a retreat in the US dollar. Right away, you see crude oil scoring big, over 2% for the day. Likewise, we see a rise in metals: gold, silver, platinum, copper, palladium, all closing in the green today. What do we see here for softs? Decent session for cotton, sugar, closing almost 2% in the green. Coffee and cocoa, modest gains for the day, about 0.5% or so. When you mix the two together, you get mocha. However, the laggards of the day: OJ closing down by about 0.5 percentage point or so. But lumbar is the notable loser for the day, closing down about 2% in the red. What about meats? Gains for live cattle, lean hogs almost 3% for the session. However, feeder cattle is muted for the day. What about grains? The inflation continues in food. Everything is getting expensive. Is the Fed doing anything about it? No. The Fed doesn't consider a rise in food prices as inflation. Can you believe that or not? You better do. But here it is. Gains for soybean products, corn, wheat closing over 2% for the session. Canola, rough rice, muted, yet closing in the green. The laggard of the day is oats, closing just slightly in the red. Moving on to the big casino, the options market. What do we see here? As expected, tomorrow we have a half a session of trading. We're seeing the volume dies day by day. Today, the volume was very low in the stock market and in the casino as well. Yet the hottest table remains the Apple table, with over 1.4 million contracts. Over 77% of those were calls. Tesla number two, with about 900,000 contracts. About 58% of those were calls. Palantir at number three, with over 500,000 contracts traded for the day. About 77.5% of those were calls. And here are the unusual activities for today's session. Right away at number one, we see a bearish trade for the IWM small caps. They've been trying to pick up the top for small caps for weeks now with no success. But one of those days, they will get it right very, very soon. We are getting very close here. You saw the Russell closing at 2,000. It did not close at 2,000 last time I checked, but it did trade at 2,000 at some point today. That could be the milestone and the top. We will see what happens tomorrow. But for now, here is a bearish trade. Buying the 183 puts, expiration date January 22nd, with expectation that the IWM will decline over 8% by then, and they are paying about $2 a piece for this trade, bringing the total dollar amount to over $3 million. What about Quantumscape? We see this name heating up among the Robinhood crowd. We did see the pump the last few days, and we are anticipating the dump. We saw a little bit of that, a little taste, and here is the trader betting on more downside for Quantumscape. And they are doing it via a put spread. It's a very expensive trade, by the way. They're buying the 100 puts, expiration date January 29th, with expectation that Quantumscape will decline over 10% by then, and they are paying $35 a piece for this one alone. And in this case, the trader opened about 13,000 contracts, which brings up the total for this trade to over $45.5 million. But to reduce the risk and reduce the entry price, what they're doing here is they're also selling the 85 puts for the same expiration date of January 29th, and they are collecting about $23 a piece for this one. And again, they are selling the same quantity of 13,000 contracts, meaning that they are paying $35 a piece for the 100 puts, but they are receiving credit for selling the 85 puts, and they are collecting $23 a piece. All in all, they are reducing the entry cost to about $12 a piece, meaning that this particular trader is risking over $15 million for this trade alone. This trader is a shark, and they are betting that the top is already in Quantumscape. The stock is not going to rise higher again. The top is here. This is what this trader is saying, and he or she putting over $15 million in this bet alone. Very sizable trade and very, very notable. If I am a holder of Quantumscape, I would take my profits right now. There is, of course, the chance that this trader is wrong and they're going to lose $15 million. But again, risking that kind of capital tells me that this trader is a professional. They know exactly what they're doing, and they are betting that the top is already here in Quantumscape. Here is another interesting trade for the Brazilian ETF, the EWZ. And in this case, they're buying the 33.5 puts, expiration date January 8th, with expectation that the Brazilian ETF will decline over 8.5% by then. And they are paying about 25 cents a piece for this trade. Continuing here, we see the triple Qs, another bearish trade, buying the 263 puts, expiration date February 19th, with expectation that the Qs will decline over 15% by then, and they are paying about $2.50 a piece for this trade, bringing up the total to almost $3 million. And here is an interesting one for Goldman Sachs, the ticker GS, and this is a bullish one. They are buying the 280 calls, expiration date January 8th, with the expectation that Goldman Sachs will rise over 9% by then. They're paying about $1.25 for this one, and the trade is costing over $1 million. The way I read this trade is that somebody who is a Goldman Sachs shareholder is trying to raise some cash or exit the position altogether if the strike price is hit. But of course, in the process, they are raising over $1 million. We also see notable activities here for FireEye. The Robinhood crowd is gambling on this name right after the cyber attack against or government agencies. Now, the attack happened due to a failure from FireEye. So you would think they will short this name or sell it? No, they are buying the name, and you saw FireEye recovering all the losses from after the announcement of that news of the cyber attack and adding significant gains for the session today. And here's a trader betting for more upside tomorrow. They are buying the 26 calls expiration date, Christmas Eve, aka tomorrow, and they are paying about 15 cents for this trade. And of course, for the trade to work, they need FireEye to gain over 8% by tomorrow. This is the insanity. The entire cyber attack happened due to the failure of FireEye. Why the hell would you buy the name that failed to do the job? But remember, we are in the video game market. Good news is good news, bad news is good news, and worse news is even better news. And speaking of the news, let's move on to the headlines that shaped the day. And right away, we have some data about bankruptcies, and this is very alarming. The monthly bankruptcy filings for the month of December surged way higher. Now, since the pandemic started, we peaked in cases of bankruptcy in July. Since the stimulus, we've been trending lower and lower and lower, normalizing any concerns about a wave of bankruptcies. However, the action in December is a massive reversal to the upside, and if we see a confirmation next month, that would be a very alarming signal for the state of the economy. And this is why this round of stimulus could not come at a better time. We need it now to prevent this wave of bankruptcies from growing larger. And we also had the news about the weekly jobless claims. And this time around, we got 803,000 claims versus 888,000 expected, meaning that we did a little better this week. However, the number remains very, very elevated at over 800,000 people claiming unemployment every single week. But perhaps the most important news happened yesterday after the bell, when President Trump pretty much said that he will veto the stimulus bill because it is not sufficient. It is garbage. And he is asking to reallocate some of the money that Congress and the Senate decided to allocate to foreign countries and the reincarnation of the Dalai Lama back to U.S. citizens. And President Trump is asking for a minimum of $2,000 per person instead of the pathetic $600 in the current stimulus deal. Now, the Democrats and Nancy Pelosi were immediately embarrassed that Trump is the one asking to up the stimulus payment for people. And they decided, hey, you want $2,000? We'll go with $2,000. What do you say, Mitch? Let's have a vote. Of course, the Democrats have been called out on Twitter along with the Republicans. Matter of fact, the hashtag "Vote them all out" was trending on Twitter. People got sick to their stomach from the disgusting stimulus bill that only allocates $600 to U.S. citizens, yet billions and billions of dollars to foreign countries, museums, and universities, wasting money all over the place. And now we will see what will happen tomorrow. They will have a vote, an exception on Christmas Eve regarding the $2,000 stimulus bill. Now understand, if we do have $2,000 instead of $600, that would be very bullish for the market, because a lot of that money will go into buying stocks, Robinhood, but specifically buying call options. And here it is again from Trump and his vetoes. He vetoed a $740 billion defense bill, and that was against his own party. This news hit during the last hour of the day, and of course everybody is associating the flush down in the stock market during the last hour to this piece of news. It could be that the market's starting to see signs of a last-minute chaos of the Trump presidency. That could happen, but remember, we are in 2020 anyways. This year has a final twist to come. Believe me, there's another thing, another shoe to drop before the end of the year. Moving on to Brexit news, and we had an outline of a post-Brexit trade agreement between the United Kingdom and the European Union. Finally, we can put the Brexit deal behind us, Brexit optimism behind us. We're done with it. We were done with the stimulus optimism. We were done with vaccine optimism. However, we're now back to stimulus, bigger stimulus optimism. Once that's done, what do we have left? New Year's optimism. It's a new year. You have to be optimistic. And here is a piece from Charles Schwab about market sentiment. Charles Schwab's chief investment strategist warns about quote-unquote extreme investor sentiment is putting the market at risk of a pullback. And here it is. Charles Schwab chief investment strategist Lisanne Saunders says sentiment has become too extreme, putting the market at a risk of a sharp pullback in 2021. Now I know what the Robin Hoodiots are going to say. Lisanne Saunders, what does she know? What does that loser know anyway? She's been wrong about the market this whole year. We, the Robin Hoodiots, nailed the market. The only problem is that Lisanne Saunders been trading since you guys been in diapers, and some of you were not even born yet. But somehow, you know the stock market better than her. And here is the last piece of news I want to share with you, and it is corporate specific. Remember the scam of Nikola? Here it is. Nikola and Republic Services, the garbage company, terminate partnership on garbage trucks. So why the hell is Nikola even trading? Why is it not at zero right now? Is there anything left here for this particular stock? Any optimism left? No, there is not. They lost the contract with General Motors, and now they're losing the contract between them and Republic Services. What is there left? Nothing. There's nothing left. The stock should go down to zero. And now let's move on to the heat map analysis and see what happened today. Right away, we see it is a mixed picture, but it is abundantly clear that it is a weaker dollar theme. Today, we saw the dollar declining. What is outperforming? Energy, basic materials, industrials, and we also saw yields rising. So what is outperforming? Financials, banks rising today. So let's go through the heat maps, starting with technology sector. Right away, you see the big boxes of Apple and Microsoft suffering losses, modest ones, but we saw significant weakness here for Square and some of the software names that have been outperforming significantly the last few days, namely Shopify, down over 6%. But you have to remember that this name has been on a tear recently. We see Snowflake down significantly, almost 3%, Workday down over 3, almost 3.5%, DocuSign down 3%, Trade Desk down almost 5%. Shifting to communication services, what do we see? The big boxes of Google and Facebook closing in the green, yet very muted for the session. The notable winner is Disney, closing at about 2% or so. And we do have AT&T. We talked about AT&T yesterday. We said that the declines that we have been seeing the last few days could be a buying opportunity, and today you see AT&T rising a little over 1%. The notable laggards of the day, Netflix losing over 2% this session. We have Zoom down big over 6% today. Moving on to consumer cyclicals, the big boxes of Amazon, Alibaba, Tesla, all muted for the session. Where do we see the gains? The reopening trade. We see General Motors up almost 4%. We see Marriott, hotels, Hilton, all closing significantly in the green. Casinos, apparel retail, TJ Maxx, Ross Stores, L Brands. But we also saw gains for cruises. And the notable gainer here is Norwegian Cruises, closing above 6% for the session. The laggards of the day, the notable ones are Carvana, down over 7%, Wayfair, down over 9.5%. Now, we talked about this stock during the weekend, that it is making a bullish consolidation. But today the name got a whack on the head, meaning that we are a little too early in this call, and Wayfair needs a little more energy to break above the upper limit of the consolidation range. As you can see from this chart, we also see declines for Etsy over 3.5% and weakness for residentials, Lennar, D.R. Horton, Toll Brothers, all down by the tune of about 2% apiece. We do have a bearish trade for D.R. Horton because D.R. Horton has a head and shoulder formation. I have a put trade expiring January 15th. We will see how the trade works out by then. But for now, it is working as expected. Moving on to consumer defensives. What do we see here? It is a positive picture with exception of Walmart closing over 0.5% in the red. The notable outperformer here is Dyson, rebounding by over 3% in the green. What about REITs? REITs suffering today. We saw a rise in yields. That is not good for REITs or utilities. But here it is. Public storage down over 2%, American Tower almost 1.5%, and we see declines for Equinix down almost 1.5%. What about utilities? Similar story. Weakness for Duke Energy, Next Era Energy, the Southern Company, but we do see Dominion closing just slightly in the green. What about basic materials? Right away, you see the dollar declining. What happens? Copper names outperform. Freeport-McMoRan closing over 2.5% in the green. Gold miners, no exception here. They did pretty good. We see gains for Barrick Gold, Newmont, Franco-Nevada, and when we move over to industrials, what do we see here? The notable outperformers are the airline companies. We saw massive gains here for Southwest, Delta, JetBlue closing over 4% for the session. We also saw gains for the defense contractors, whether we're talking about Lockheed, Raytheon, Northrop. We saw gains also for CAT and General Electric. The laggards of the day led by the shipping giants UPS and FedEx, both closing in the red. What about energy? The winner of the day, right away we see Chevron closing 1.5%, and we see gains for Exxon, British Petroleum, Phillips, Pioneer, and Occidental. Moving on to the healthcare sector, what do we see today? Rebound day for Pfizer, closing almost 2% in the green, and the same story goes to Moderna, closing above 3.5% for the session. The laggards of the day, led by Eli Lilly, a name that has been winning for weeks now. We saw notable declines here for Thermo Fisher, Illumina, the diagnostics names. And of course, one of the notable losers here is Align Technology for the Invisalign braces, down over 2% for the session. Moving on to financials, one of the outperformers. Today, we see a resumption of the gains right after the Fed allowed banks to buy back their shares. We see Morgan Stanley, Goldman Sachs, Bank of America, JP Morgan, Citibank, all closing above 2% for the session. And check out Wells Fargo, almost 5% for the day. The laggards are, of course, the credit services, MasterCard down, Visa down, but notably PayPal down over 1.5%. The outperformer here in credit services is the reopening name, American Express, closing above 2% in the green. And to illustrate the theme for you, today, let's visit the rotation trade. It is abundantly clear that today was a rotation trade kind of day. Outperformance specifically from Southwest, American Express, Six Flags, General Motors, Planet Fitness, and Royal Caribbean. The only name that is lagging in the reopening stocks is Live Nation, closing down by about 0.5 percentage point. When we look at the stay-at-home stocks, the notable laggards are Shopify, Netflix, Zoom, DocuSign, Nvidia, and the notable outperformers, we have gains, a rebound for Tesla, Peloton, continuation of the gains, and Zillow remains a very, very strong name. Moving on to the charts analysis, and let's see what happened here during this very low volume day. Starting with 50 minutes chart of the SPY. You see that we gapped higher. When they can't push the market higher during the session, they resort back to pumping the market overnight. And today we saw a gap higher. However, retail is not picking up, trading flat throughout the day, facing resistance and reversing from what level? 369.60. You think these numbers are picked randomly? Think again. However, the funny business happened during the last hour of trading. We saw a big flush down. You can pin it on the news from the Trump administration vetoing the defense bill. You could pin it on profit taking before Christmas. Whatever it is, it doesn't matter. It is a bearish closing, yet in the grand scheme of things, the SPY remains bullish. And to illustrate that for you, let's zoom out and visit the continuous contract here, the SPY futures. What do we see? We are still trading at the upper limit of the trading range. We are facing significant resistance at the trend line. However, the chart is trading above the pivotal level, the very important level of 3,600, and it is gathering energy to do what? To break above the upper limit of the consolidation range. The only way we will know that the chart has turned bearish, and we are looking for a reversal and a continuation for perhaps a correction, if this chart closes below 3,600 for the day. Until and unless we see that, we remain bullish for the SPY. Moving on to the Qs. What do we see here from a 15 minutes perspective? Right away, you see that the Qs open a little weaker when you compare it to the SPY or the IWM. It did not gap higher significantly. But we caught some momentum throughout the day and the Qs managed to trade higher. All the way, of course, till the end of the day when we saw the indices flushing down. In this case, the Qs closing below 308.50, which is an important level of support. So that is bearish, but we do have a trending line that we are looking for support. And to illustrate that, we need to zoom out and revisit the daily chart for the Qs. What do we see here? We talked about the consolidation and the formation of perhaps a new trend until and unless we break below the trend line, and after that the confirmation will be breaking the next support line of 303.35. If that happens, it means that we will see a correction in the Qs. The trend is over and that would pave the way for the 10% correction scenario. Moving on to the IWM 15 minutes perspective. Yesterday, we saw bearish formation. We saw a retreat from a double top almost and a bear flag formation. The expectation was that we will trade lower from a 15 minutes perspective. But remember, we are trading in range here. So we were calling for a retreat, perhaps revisiting the lower limit of the range and then bouncing higher. However, to defeat any bearish formation, you could do that by gapping the indices higher overnight. This is exactly what happened. We saw the IWM opening higher, marching all the way to the upper limit range, facing resistance, pulling back, and then flushing down with the rest of the indices during the last hour of trading. However, the flush down here in the IWM is less notable when you look at the SPY, the Qs, the Dow Jones. So for all intents and purposes, small caps, the Russell remains the strongest name to beat. And when we zoom out to a daily chart, what do we see here? Remember, yesterday I showed you the rising wedge, and this is why I don't like it. I told you I don't believe in rising wedges. They just don't make sense to me because we broke below the rising wedge and we're back in it again. So what is the point here? It did not tell you anything. I trust the MACD and the RSI to show me how strong the momentum is. I combine that information with the support lines, and if we see a curling down in momentum in the RSI, a confirmation from the MACD, and then breaking the support level of what? 191.5. That would be your confirmation that we are reversing here in the IWM. Moving on to the Dixie. What do we see here? Today, it was a retreat day. The Dixie did not flush down. It closed within the range of yesterday's candle. It is just taking a break, gathering more momentum to break and close above the important level of 90.5. It will do that. I have no doubt that the dollar index will gather enough energy to break above that. What does that mean for gold? We saw gold rebounding today, closing above the important resistance line of 1870. However, if we do see a resumption of the rally, the oversold rally in the dollar index, gold will retreat and go lower. So again, these two charts, they pretty much trade in opposite directions of one another, at least during this time period. And what happened in yields today? Big day for yields. We saw yields rising higher, and that of course lifted all the bank names and the financial sector higher. You cannot doubt here that the destination is 1%. Sooner or later, we're gonna hit 1%, and perhaps passing a bigger stimulus will be the catalyst for that. The question is, how will the stock market react? I keep bringing up this point over and over again because the multiples have expanded significantly. And if we do see yields in a trajectory to close above 1%, next destination 1.5%, then 2%, if we go to 2%, the market has to crash. You cannot justify the valuations whatsoever. That's not according to me. That's according to your boy Jerome. He's telling you to buy stocks, don't worry about valuations, because the 10 years treasury yield will remain suppressed. But we're not seeing that on the chart. We're seeing that the 10 years treasury yield is rising higher and higher every day, with the trajectory of closing above 1% and perhaps higher. And this is why I say the Fed is telling us to gamble, but it is not offering any insurance. They cannot control the 10 years Treasury yield. Moving on to the VIX, what do we see here? The VIX is all over the place, smacking pies on faces all week long. It popped on Monday, everybody got excited, they bought the VIX. What do you know? The VIX went all the way down to where it started the week, almost. But today, what happened? We saw massive bets against the VIX. They saw the retreat, and of course everybody's assuming, because they have a technical analysis book, and it says that the candle on Monday is a reverse hammer, meaning that the VIX will decline significantly from that point on. Be careful how you read the tape, because what they did is they bought 2 times puts to call ratio. What happened during the last hour of the day is the VIX recovered and closed pretty much at the highs of the session, suggesting that perhaps there is another pop here for the VIX. I've been telling you for a long time, the VIX chart is speaking to me, and what the VIX is telling me, I am not ready to retreat. I have another final act, a very big one, a large one, larger than 40 in the books, and I'm not gonna go down until I perform my last act. We're almost done with vaccine optimism. We're going to be done with stimulus optimism, with Brexit optimism, and pretty soon with the whole split government optimism. What happens next to the market? What is next to feed the market's trajectory higher? Corporate earnings are not going to support the valuations. Yields are going to rise. What happens after that? The only thing is that perhaps some stimulus money is going to prop up the economy and the stock market for a few more months, perhaps the first quarter, all the way to the second quarter, and then what? And this is why the VIX continues to be elevated. Moving on to Apple, what do we see here from 15 minutes perspective? Again, trading in range, closing pretty much at the support of 131. Nothing new here. If we flush down tomorrow, we do have the 125 support. Of course, there is the gap. That would be a destination to fill. And then if we see a rebound, that would be healthy for Apple. But if we go to the gap and we continue to flush down, look for 125 for support. And here is the last chart of the day for Tesla. What do we see? Today was a rebound day. We caught support yesterday from the 20 days moving average. Today we're bouncing higher. Another continuation of that move. Tesla remains bullish. There is nothing to see here until and unless we close below 599. Tesla will try to gather more energy to challenge the upper range, or the upper limit of the range rather. It did that during quadruple witching, but I told you that is the exception. It has to do it organically, on its own 2 feet by retail traders. We'll see if that happens, but if the opposite happens and we close below 599, that is your shorting signal. And now let's move on to conclude this video by answering some viewers' questions. Starting with this question. Another good video, thanks. Can you please explain if call option nominally, or the notional value he means, exceeds the daily volume? Does it mean that the market maker needs to keep buying shares even for days to hedge, unless they already have the shares for the option they sold for? What the viewer is asking pretty much is, we will look at Apple options, specifically a few days ago when it was trading over 3 million contracts. I said that the notional value, the notional volume of the options traded today for that particular date exceeded the actual volume that was traded for the stock, for the underlying stock of Apple. So what does that mean? Remember, when you buy a call option, the seller either has the shares and they are selling you upper calls and they don't mind selling their shares at that particular price, or they sell you the option and then they buy the underlying stock as a hedge. And what happens is, if you see a rally in the stock, your call options are going to appreciate and the option seller will gain from buying the stock. What they do usually is, once they make significant gains from the underlying stock, from buying the actual stock, as we get closer to expiration date for the call option that you bought from them, these guys get greedy. They say, look, we bought the stock, we made profits, now there's this guy who owns the calls that we sold, and he wants us to sell for a lower price than where the stock is trading right now. For example, let's say that you bought the 335 calls for Apple and the stock is trading at 330. So the option seller is going to buy the stock at 330 and write the 335 calls for you. Now let's say that we are trading at 340 now and we have a few days for expiration. What is the incentive for the option seller? The incentive is that they sell the shares at 340, capturing $10 worth of profits, crashing the stock, and making sure that it will close below 335. So it happens that your call options expire worthless and they have no obligations whatsoever to deliver the shares for you at the price of 335. I hope this is clear. Now, why do we see sometimes a surge in options volume, specifically call options volume for certain stocks, and we see that accompanied hand in hand by a surge in the trading volume of the actual stock? But sometimes we see a surge in the volume of options trading, but we don't see the same surge for the volume traded for the underlying stock. Why is that? The simple explanation is, for a large stock like Apple, which is widely held, they can sell you all the call options you want. They need not to buy the stock. They already own it. And this is why you do not see the volume traded for the stock surging higher. And you see that the notional volume for the options traded exceeding the actual volume traded for the stock. Now let's talk about a stock that is not widely held. And all of a sudden we see a surge in call options buying. Somebody threw the ticker in TikTok or whatever it is. And now we see a stampede to buy call options. In this case, option sellers have to buy the underlying stock, causing that volume to surge higher and paving the way for the pump and dump scenario we just talked about. You don't see the pump and dump scenario in a widely held stock like Apple because they already have the shares. They bought them back when the stock was trading at 100, 200. They need not to create a pump and dump scheme. Where do you see the pump and dump? In names like Quantumscape, Plug, all these names that are not widely held. I hope that answers your question. And here is the second question. Enjoyed the video, entertaining and informative. Thank you. Any suggestions for a long-term monthly dividend paying stock? When we talk about dividend-paying stocks, they're pretty much extinct species. And the reason is you want to look at reliable dividend names. With the recent crash of the coronavirus, a lot of companies forgo the dividends. So let's take a look at the dividend heat map. Right away, when we look at the technology sector, are you interested here in any names? You have IBM giving you over 5%, Broadcom over 3%. But are you really interested in these names? Because what is the point of buying a stock that pays you dividend, but it is underperforming and has a downside potential due to a correction? So we're not looking at anything here for the technology sector. Moving on to communication services. Do we see anything here? We do have the old school names of Verizon and AT&T. Verizon gives you a little over 4% dividend yield. AT&T gives you over 7%. AT&T is a little risky. And this is why the dividend yield is higher, because AT&T bought a bunch of garbage businesses like Dish Network, and they need to rid of these businesses before the company becomes lean and growing again. Verizon, on the other hand, is a much safer dividend. This is an old school name, very solid, very strong. It trades in range. It pretty much doesn't grow a lot. It is exactly what you want from a dividend stock. Don't expect that the dividend stock is going to grow 10%, 20% a year. That doesn't happen. For a reliable dividend stock, you want to look for boring, slightly grinding higher, but very safe dividend. And Verizon is that name. Let's take a look at consumer cyclicals. We do have Toyota, one of my favorite names, and Toyota will pay you almost 3% dividend. This is a no-brainer, and I will add Toyota to my portfolio next year. But we also have another old school name, McDonald's. This is a very safe dividend. It's not going anywhere. It's about 2.5%. This is a classic dividend name. It is not a high beta name, but yet it manages to grow and score significant growth year over year. So this is a perfect dividend name. What about consumer defensives? They're known for their dividend yields. Primarily Procter & Gamble, the king of dividend stocks. Very safe, very reliable business. The stock grinds higher and higher every day. and it pays you about 2.3% dividend. Now, you could say that Procter & Gamble is a little overstretched and you're not comfortable buying it right now. What do? You got Coca-Cola, you got PepsiCo. These are all reliable dividend names. But remember that the pandemic hit Coca-Cola and PepsiCo a little harder. Meanwhile, Procter & Gamble was not even touched by the pandemic. It actually grown due to the stay-at-home environment. Now, here are names that we are not interested in. Philip Morris, all these weaker names that has high dividend yield, forget about it. Don't chase the higher dividend yield when the underlying stock itself is weak. We'll avoid real estate and utilities because the rise in the 10 years treasury yields will hurt real estate and utilities. We're not interested in basic materials for yields. Similar story for energy. You don't go and buy energy names for yields anymore because the risky and the recovery story for oil is still a long way to go. Now, you could be lucky enough that you bought Exxon at the bottom and you're going to cash in 10% dividend. But remember, the dividend is not safe here. Oil companies are in a world of pain when it comes to the balance sheets. They are able to keep the dividend for now, but it is not safe. So it is not wise to invest in these energy names just for the dividend. Similarly, for industrials, there are some reliable names such as UPS, Caterpillar, Emerson. Those will pay you about 2.5% apiece. And you also have the defense names, specifically Lockheed Martin. It gives you about 3% dividend yield. However, the stock hasn't been performing very well recently. So we will not bother with industrials to seek dividend yielding stocks. What about healthcare? These are very good names. They're very cheap. They pay a lot of dividend. The only risk here is if they flop a drug trial or if there's a promising drug that doesn't get approved by the FDA. You always see volatility here in these names. So if you're going to seek dividend yielding stocks from the healthcare sector, stick with large, reliable, old school pharma companies. We're talking about Merck, we're talking about Johnson & Johnson, we're talking about Eli Lilly, but my favorite name is AbbVie, yielding a little over 5%. Now, Warren Buffett added this name to his portfolio at Berkshire, and when I do the forensics, I like the name a lot, and it is on the top of my list for stocks to buy in 2021. AbbVie, I like it a lot. What about financials here? You could buy any of the two big banks, JP Morgan or Bank of America. Bank of America will give you about 2.4% yield. JP Morgan will give you 2.8. Stick with these two. Don't try to be cute and buy Citibank or Wells Fargo. These are the weaker names. Either JP Morgan, Bank of America, or Morgan Stanley. Morgan Stanley pays about 2% dividend. And as you know, Morgan Stanley is one of my favorite names. So pretty much this is it. You could look for Verizon, McDonald's, Toyota, Procter & Gamble, Coca-Cola, PepsiCo, and then you have the pharma names, Johnson & Johnson, Eli Lilly, AbbVie, and the big two banks of JP Morgan and Bank of America. There are names that are yielding good dividend. For example, International Paper yielding over 4%. It's a name that I have in my portfolio, and it is performing very well since I bought it. But it is not reliable. The reason is the rise of international paper, for example, will depend on a weaker dollar. So for whatever reason, if we see a strengthening in the US dollar, international paper will perform poorly as a stock. Your goal here is to pick a name that pays a reliable dividend and the stock to perform and yield gains as well. For me personally, as I said, I will go with AbbVie, the ticker ABBV. I like it. Warren Buffett likes it. This is a name I will definitely add to my portfolio next year. Moving on to the last question of the day, and here it is. Are you still holding your Kroger position? I bought it on the dip, as you did as well a few videos ago. I was thinking of holding until 33, but it is looking pretty shaky still right now. Let's take a look at the chart of Kroger first, and then we'll talk about the stock. Here is what happened in Kroger stock since the rotation trade started. We saw a sell-off and a loss of momentum, and we saw Kroger trading lower. We are now catching support from the level of 30.30 in a double bottom formation. And what you are hoping for is enough momentum to crack above the descending trend line of resistance and breaking the resistance line at about 32. If that happens, then the stock overall will reverse the bearish trend since the rotation trade started, and it will start a new bullish trend. When do you know that you should bail out and move on? If you see the stock closing below the level of 30.3. Now, let's talk about Kroger as a stock. This is a solid business. It is not going anywhere. It produces a significant amount of cash flow. The dividend is very, very safe. They're going to buy back their shares. When you look at their results, for example, they're doing everything right. Their digital sales last quarter grew triple digits. 108%. It is delivering in every aspect. You have Warren Buffett buying on the dips for 2 quarters in a row. But there's something important that you have to keep in mind. This is a long-term hold kind of stock. If you are planning to buy the stock for a trade or you're expecting 10% gain within 6 months or so, you are picking the wrong stock. You're better off picking something that has more potential for growth as a stock, perhaps in the technology sector, because this stock is not a trading stock. It is a buy and hold. You put $1 million in Kroger stock, you collect 2.5% dividend yield minimum because they keep hiking the dividend rate. In 4 years, you collect about $100,000 and the stock at least will grow 20% from where you bought it. All in all, in 4 years, you'll have returns of about 30%. Kroger is this kind of stock. It is a buy and hold, large amount, collecting dividend yield. It is not a trading stock. So if you're expecting 10% return from a stock like this in 6 months or 3 months, you're better off finding a stock in the technology sector, consumer cyclicals, even industrials and healthcare. There are names that pop 3% a day and they have higher growth potential as a stock in the short term when you compare it to Kroger. So I hope this was clear for you. And here we are. We have reached the end of this video. We have a half a day worth of trading tomorrow. It is Christmas Eve. And then we have the big day of Christmas. And we are off on Friday. We'll be back next week on Monday. If we don't see notable activities tomorrow, there is not going to be a daily video. However, I will upload some highlights and some videos that I haven't released yet for your entertainment purposes, of course, in case you get bored during the Christmas holiday. My message to you is Merry Christmas, Happy Holidays, enjoy yourself and your family, and I will talk to you again soon.